Warren Buffett, often referred to as the Oracle of Omaha, is one of the most influential and successful investors in modern history. He is considered a role model for anyone dreaming of building wealth and achieving success. His success story is not just about amassing wealth, but rather a testament to the idea that perseverance, patience, and continuous learning can transform anyone's life. Born Warren Edward Buffett on August 30th, 1930, in Omaha, Nebraska, during the Great Depression, this period was one of the most challenging economic times in American history. Millions of people lost their jobs and businesses, but Warren's family was relatively stable compared to others at the time. Growing up in these difficult circumstances gave him the early lessons on the importance of money and resource management. Early life and humble beginnings. Family. Warren's father, Howard Buffett, was a stockbroker and a congressman. His mother, Layla, was a housewife. While the family lived relatively comfortably compared to many others during that period, Warren learned from his father the value of hard work and financial discipline. The family instilled in Warren the importance of money, but also the idea that hard work was the only way to build wealth. The first signs of genius. From a very young age, Warren exhibited an extraordinary ability to spot financial opportunities. At the age of 6, he bought a pack of gum for a few cents and sold it to his neighbors for a small profit. This wasn't just a simple childhood business. It was the beginning of Warren's love for numbers and profits. Later, he expanded his entrepreneurial efforts to selling Coca-Cola bottles, buying them in bulk at a discount and reselling them individually, making a profit every day. These early ventures taught him the basics of business, such as buying in bulk and selling at a margin. His first step into the stock market. At the age of 11, Warren decided to invest in the stock market for the first time. He purchased 3 shares of City Service at $38 a share. While the stock price dropped to $27, he decided to hold on to it. Eventually, the stock rose back to $40, and he sold his shares, making a small profit. However, soon after selling, the stock price shot up, which taught him one of his most valuable lessons. Patience is key in investing. A passion for reading. Warren has always been a voracious reader. As a child, he read a book titled 1,000 Ways to Make $1,000, which inspired him to think creatively about wealth. Reading became his primary means of expanding his knowledge of money and business, and he developed an incredible ability to apply what he read to his practical life. During his teenage years, he worked delivering newspapers, waking up early and working hard to save money. By the age of 16, he had saved about $6,000, which was a substantial amount at the time. This amount would serve as the foundation for his early, serious investments. Academic education. After high school, Warren attended the University of Nebraska, where he earned a degree in business administration. Although this university wasn't as prestigious as others in the field of business at the time, Warren made the most of the opportunity to learn the basics and develop his skills. After graduation, he wanted to continue his education, but he was rejected from Harvard University. Instead of feeling discouraged, he went on to attend Columbia University, where he studied under Benjamin Graham, the father of value investing. At Columbia, Warren learned how to evaluate companies based on their intrinsic value rather than focusing on their market price. This lesson became the cornerstone of his investment philosophy, which would shape his future. Graham taught him that successful investments come from understanding the business, not just predicting market fluctuations. The professional beginning. After graduation, Warren worked for Benjamin Graham's investment firm. Although he had a decent salary, his ambitions were much higher. He didn't want to just be an employee working for someone else. In 1956, he founded his own investment partnership, Buffett Partnership, Ltd., with a small amount of capital that he raised from friends and family. The partnership focused on buying stocks of companies that were undervalued relative to their intrinsic worth. Warren wasn't just an investor, he was an astute analyst, examining every aspect of a business before making a decision. His ability to analyze deeply was one of the reasons he rose quickly in the investment world. His choices weren't limited to just picking companies, but were based on solid fundamentals. He always focused on the quality of the businesses he invested in, not just short-term forecasts. The Berkshire Hathaway acquisition. In 1962, Warren began purchasing shares of Berkshire Hathaway, a textile company facing significant financial challenges. Rather than selling the company off, Warren decided to transform it into an investment empire. This was an unconventional move, as most investors would have steered clear of buying struggling businesses. However, Warren saw an opportunity in the company, and in the years that followed, Berkshire Hathaway became one of the largest investment firms in the world. Berkshire Hathaway later acquired stakes in major global companies such as Coca-Cola, Apple, Gillette, and American Express. These investments weren't just financial transactions. They embodied Warren's philosophy of investing in companies that had staying power, innovation, and the ability to weather challenges. The investment strategy. Warren's investment strategy is simple, yet incredibly effective. 1. Invest in businesses with strong fundamentals. He always sought companies with products and services that people would continually need, regardless of economic conditions. He didn't follow short-term investment trends, but preferred to invest in stable companies that had a solid foundation. 2. Focus on the long term. Warren didn't care about the daily fluctuations of the stock market. Instead, he focused on building investments that would pay off over decades. He looked at whether a company would continue to grow and add value to its customers. 3. Avoid complicated investments. Warren never invested in industries he didn't understand. He avoided risks in areas where he had no deep knowledge, which was one of the main reasons he avoided large losses. Major achievements. Over the following decades, Warren invested in some of the world's best companies, leading to massive financial gains. For instance, his investment in Coca-Cola in the 1980s is now considered one of his most successful. He also acquired companies in industries like insurance, railroads, and energy. These investments were not just business deals. They reflected Warren's long-term thinking. Each investment was made after a deep understanding of the market trends and the future direction of the companies he chose to invest in. Humility and simplicity. Despite his immense wealth, Warren leads a very simple life. He still lives in the same house he bought in the 1950s for $31,500. He enjoys simple meals like hamburgers and Coca-Cola and doesn't care much for lavish displays of wealth. This humility isn't just a personal trait. It's a reflection of his life philosophy that money is not the ultimate goal, but a means to achieve greater objectives. Giving back and philanthropy. In 2010, Warren, along with Bill Gates, launched the Giving Pledge, a campaign encouraging wealthy individuals to donate the majority of their fortunes to charity. Warren himself has pledged to give away most of his wealth to philanthropic causes. He believes that wealth should be used to improve the lives of others, not just to accumulate money. This initiative was a call to action for other wealthy individuals to play a larger role in improving society. Investment lessons. 1. Start early. Time is the most important factor in building wealth. Warren began at a very young age, and the earlier you start learning and planning financially, the more chances you have to succeed. 2. Be patient. Don't look for quick profits. Wealth comes over time. Profitable investments usually take a long time to yield substantial returns. 3. Invest in yourself. Knowledge is your greatest asset. Continuous reading and self-education are key to long-term success. 4. Live within your means. Happiness doesn't require extreme wealth. A balanced life built on values is more important than simply accumulating money. Conclusion. If Warren Buffett's story inspired you today, share this video with your friends so they can benefit too. Don't forget to subscribe to the channel and turn on notifications. Share with us in the comments, what's the most important lesson you've learned from this story? Thanks for watching, and we'll see you in the next video.